right, so hey everyone, thanks for tuning in today. We are going deep inside UBS by taking apart their 2024 annual report. It's going to be a fun one.
Yeah.
We're trying to make this your go-to guide for really understanding this major player in global finance.
Yeah.
What are their different businesses doing? How healthy are their finances? And what's their vision for the road ahead?
Yeah. And we're going to do that without, drowning in spreadsheets.
Exactly.
Yeah. We're going to really try to pull out the big insights, the stuff that matters most about their different segments, how much money they're making, and what their plans are for shareholders like you.
Right. And I think it's important to get it right off the bat. We got to remember where we are in time, right?
Yeah.
2023 was a huge year with UBS acquiring Credit Suisse.
Yeah, absolutely.
And, they really stepped up as a key player in making sure the financial system didn't completely, implode.
Yeah, stepping in as part of the solution.
Exactly. And they had, the backing of Swiss authorities.
Oh.
But what I think is really interesting is they've made it clear they're committed to making Switzerland's financial system even stronger,
Yeah.
But they're not looking for any special favors or loopholes.
Absolutely no regulatory concessions.
Exactly. So let's talk money for a second.
Right.
The report shows that because of the Credit Suisse deal, their required capital has gone up by almost $20 billion.
Yeah, that's a big number.
A big number, and it's because Credit Suisse had certain regulatory breaks that are no longer in place. That's about $9 billion right there. And then there's the full weight of those too big to fail regulations kicking in, which has another roughly $10 billion.
Right.
So it's a big statement, especially considering that UBS is already operating under some of the toughest risk-weighted capital rules out there globally.
Some of the highest in the world, yeah.
So, okay, let's, pop the hood, so to speak, and really look at how the UBS engine runs. How are their businesses structured, and where do they see the most promising avenues for growth?
So their strategy revolves around what they call sustainable and strategic growth, which makes sense, right? You want it to last.
Yeah.
And they're really setting their sights on the Americas and Asia Pacific as the key battlegrounds for attracting new assets.
And that makes sense.
Yeah.
Given that that's where a lot of the new wealth is being created.
Absolutely.
So what about the rest of the world, Europe, Middle East, Africa, that whole EMEA region?
Mm-hmm.
What's their game plan there?
In those established markets, they're taking a slightly different approach, more about protecting their current leadership positions.
Okay.
But also finding smart ways to grab more market share. And one way they're doing that is by getting their different business units to work together more closely.
Right, breaking down those silos.
Yeah, exactly. More collaboration.
So let's zoom in on that wealth management business in the Americas, because that seems to be, a big focus for them.
For sure.
They're talking about making these targeted investments to get closer to their ultra high net worth clients, which, that makes sense. Those are the big fish.
Right, the whales.
But it's not just about the super rich. They also want to see big growth in their business with, high net worth individuals and what they're calling core affluent segment. So, more of that upper middle class.
Right.
And they're looking to expand their offerings of loans and deposits in that region.
Yeah, trying to capture more of the market.
Makes sense. Now, this caught my eye. They're aiming to get a national bank charter in the Americas.
That's ambitious.
It is,
Okay.
especially when you think about it. They already manage over $2 trillion in invested assets in the Americas, with nearly 6,000 financial advisors working there.
Yeah.
So,
They have a big presence already.
They do. They do. So why go for the national charter? What do you think's driving that?
Well, for you as a shareholder, this could really streamline their U.S. operations, give them even more credibility,
Okay.
and a wider reach with the ultimate goal of higher profits.
Yeah, because that's what it's all about,
Yeah.
right? At the end of the day.
Yeah.
All right, let's switch gears and talk about something that's always top of mind, cost management. The report mentions they've managed to save a whopping $3.4 billion in gross costs just in 2024 alone. And when you add up all the savings since they started integrating with Credit Suisse back in 2022, they've hit $7.5 billion by the end of last year.
Yeah, they're really making progress towards their goal,
They are.
which is to reach about $13 billion in annualized gross cost savings by the end of 2026, and they're already at about 58%.
So, they've got some serious momentum going on there.
Yeah, a lot of cost cutting going on.
And that raises the question, how does all this cost saving actually benefit shareholders like you?
Right.
Does it mean bigger profits that can be returned as dividends or used for share buybacks?
That's the key question, right?
It is the key question. And it's not all about cutting costs. They're also busy reducing risk, which is always a good thing.
Yeah, absolutely.
And they're doing that through their non-core and legacy business division, which is basically the part of the company focused on winding down those positions that just don't fit their strategy anymore.
Right, getting rid of the dead weight.
Exactly. And they've made some real headway. They've slashed their risk-weighted assets, which is often shortened to RWA, by a huge 52% since the second quarter of 2023.
That's a big reduction.
It is. It is. And what's interesting is that they're actually ahead of schedule.
Oh, wow.
So for those who aren't familiar with the term RWA, it's basically a way to measure how risky a company's assets are. The lower the RWA, the more solid the company's financial footing is, generally speaking.
Lower risk.
Exactly. So their new goal is to bring non-core and legacy RWA down to about $29 billion by the end of 2025, and then even further to around $22 billion by the end of 2026.
That's a significant reduction in risk.
It is, and when you step back and look at the bigger picture, this de-risking is really crucial for UBS, right? It lets them clean up their balance sheet, get rid of those potentially problematic assets they inherited from Credit Suisse, and then they can really focus on the core parts of their business, the ones with the best growth potential.
Yeah, makes sense.
And they keep talking about this one UBS strategy. What's that all about?
Right. So it sounds like they're really trying to break down those internal barriers, getting their different business units to collaborate more effectively and ultimately provide a more seamless and comprehensive experience for their clients.
So instead of, having these separate departments, they're really trying to create a unified front.
Exactly. A one UBS experience.
I see. Now, what are some concrete examples of how they're trying to make this one UBS vision a reality?
Well, one really powerful example is the potential synergy between their asset gathering strength and wealth management and the expertise of their investment bank in things like deal making. Right. So by connecting those two, you can offer clients a much wider range of services. Everything from managing their wealth to helping them with mergers and acquisitions or other complex financial transactions.
So it's kind of a one-stop shop for all their financial needs.
Yeah, exactly.
Makes sense. And then, they're also looking toward the future with technology, specifically generative AI. They're talking about using it in their wealth management operations.
Absolutely. They see generative AI as a game changer that could transform many aspects of their wealth management business.
So what are some of the specific ways they're thinking about using generative AI?
The report highlights several potential applications. Things like attracting new clients, smoothing out that onboarding process, making it easier for new clients to get started,
right,
enhancing the overall client service experience, and even improving internal support functions, making their own operations more efficient.
So it's really about, leveraging this technology to work smarter, not harder.
Exactly. And it's not just talk. They're actually putting this into practice. They've rolled out Red, which is their internal AI-powered chatbot, to around 7,000 employees in the fourth quarter of 2024. And that system delivered a staggering 13 million AI-generated insights to their U.S. advisors in that year alone.
Wow. So they're not just dipping their toes in the water. They're really diving in head first.
Exactly. You're embracing this technology.
And it's interesting that they're also trying to position themselves as thought leaders in this space, right? Connecting their clients with AI experts and offering insights into investment opportunities in the field of AI.
Absolutely. They want to be seen as the go-to resource for everything AI related in the financial world.
Okay, so let's shift gears a bit and talk about the regulatory landscape.
Yeah.
Specifically the ongoing review by FINMA of UBS's recovery and resolution plans,
right,
which basically means how they would handle a major crisis.
Right, and this is a big deal, especially after everything that happened last year.
Exactly. So what's the latest on that front?
Well, following the Credit Suisse acquisition, FINMA has actually hit the pause button on their annual approval of UBS's recovery and emergency plans.
Oh, wow.
Now, they do say that UBS is still resolvable under its current strategy.
Okay.
But they're pushing for even more detailed plans to give them, FINMA, more options if a crisis does hit.
Right. More tools in their toolbox.
Exactly. And this includes exploring a different approach focused on an orderly market exit, which aligns with recent recommendations from the Swiss Federal Council about how to handle institutions that are deemed too big to fail.
So it's really about having a clear roadmap for how to unwind these massive institutions if things go really south.
Absolutely, minimizing the risk to the broader financial system.
Makes sense. And of course, in today's world, we can't ignore cybersecurity, right? It's a constant concern. Yeah. And the report acknowledges those risks.
Yeah, for sure.
And those risks are, potentially even greater now because of geopolitical tensions and the increasing sophistication of technologies like generative AI, right?
Exactly. It's a double-edged sword, right? Those same technologies that can be used for good can also be exploited by bad actors.
Absolutely.
Yeah.
So how is UBS addressing these cybersecurity challenges?
Well, the report specifically mentions the ransomware attack that hit a third-party vendor, Ion XTP, in the first quarter of 2023. This incident did disrupt some of their exchange-traded derivatives clearing activities, but what's noteworthy is that they were able to restore services relatively quickly within 36 hours by using an alternative solution.
So it sounds like they have some pretty robust contingency plans in place.
Yes, they do. They had a backup plan ready to go, which is crucial in today's environment.
Absolutely. All right, let's dive into the numbers now. The financial highlights to give us a concrete picture of how UBS performed in 2024.
Okay, so starting with their income statement for the full year 2024, they reported total revenues of $34.5 billion. Their operating expenses, as reported, were $31.1 billion, resulting in a reported operating profit before tax of $3.4 billion. And then their net profit attributable to shareholders for the year came in at $5.1 billion.
Now, I noticed they also present what they call underlying figures.
Right.
What's the difference there?
So the underlying figures are meant to give you a clearer picture of the core ongoing business performance by removing certain one-time costs, those associated with integrating Credit Suisse and the accounting impact of purchase price allocation, or PPA.
Okay.
So those underlying figures show operating expenses at $34.1 billion and an operating profit before tax of $4 billion. The report points out that those integration-related costs and PPA effects had a negative impact of $285 million when you compare the underlying pre-tax profit to the reported figure. Essentially, it helps investors see the profitability of the continuing operations without all the noise from the acquisition.
Right. So it's a way to sort of normalize the numbers and see how the business is performing underneath all the extraordinary items.
Exactly.
Okay, now let's talk about credit losses. What do we see there?
So for their global wealth management division in 2024, they actually reported a credit loss release of $16 million.
Okay, what does that mean exactly?
It means that they were able to recover more from previous provisions for potential losses than they had to set aside for new potential losses. This suggests a high level of credit quality within their wealth management client base.
So basically, their loans are performing well and they're not expecting a lot of defaults.
Right. Very few bad loans.
Okay, that's good news. Let's break down the performance of their key business divisions to really see where the profits are coming from, starting with that core global wealth management business.
Okay, so Global Wealth Management delivered an operating profit before tax of $3.2 billion in 2024, which is up from $2.8 billion in 2023.
That's a solid increase.
It is representing a pre-tax profit growth of 13.4%. However, their cost-to-income ratio did increase slightly to 61.5% from 57.2%, and their net interest margin, which is a measure of how profitable their lending activities are, was 200 basis points, a small decrease from 206 basis points in the previous year. It's also worth noting that their gross loans in this division decreased by 11% to $266.9 billion, and customer deposits were down by 9% to $279.9 billion.
Okay, so a mixed bag there.
Yeah.
But overall, still a strong performance from Global Wealth Management.
Yeah, the core business is doing well.
Right. What about the investment bank? How did they do?
The investment bank showed a big improvement, reporting an operating profit before tax of $2.8 billion in 2024.
That's a big jump.
Yeah, a big jump compared to the $1.8 billion they reported in 2023.
So they're definitely firing on all cylinders there.
Yeah, the market conditions were favorable.
Okay, and what about those other main divisions, personal and corporate banking and asset management?
So personal and corporate banking saw a decrease in reported operating profit before tax, coming in at $0.3 billion in 2024, down from $0.7 billion in 2023.
Okay.
Asset management, on the other hand, reported a pre-tax operating loss of negative $0.1 billion in both 2024 and 2023, so basically flat but still in the red.
All right, and finally, let's circle back to the non-core and legacy division, the one focused on winding down assets. What was their financial impact?
As you might expect, given their goal of reducing exposure, the non-core and legacy division reported an operating loss before tax of negative $4.6 billion in 2024.
Okay.
This is a bigger loss than the negative $2.5 billion reported in 2023, reflecting the cost associated with actively exiting those non-strategic positions.
Right. So they're taking a hit now, but it's a strategic move to improve their long-term financial health.
Exactly, cleaning up the balance sheet.
Okay, let's get a snapshot of their financial strength by looking at their balance sheet as of the end of 2024.
Okay, so as of December 31st, 2024, UBS had total assets of $1,605 billion.
Wow.
Their risk-weighted assets were $499 billion, and their leverage ratio denominator was $1,519 billion. Their CET1 capital ratio, a key indicator of financial strength, was a very solid 14.5%, and their CET1 leverage ratio was 4.8%. They also had a total loss absorbing capacity, or TLAC eligible amount, of $185.4 billion and a lot of high-quality liquid assets totaling $331.6 billion.
So all those numbers point to a pretty strong capital and liquidity position.
Yes, very solid, very healthy.
Okay, now what about their cash flow situation for the year?
In terms of cash flow for 2024, UBS generated a net cash flow from operating activities of $82.5 billion. Investing activities used up $96.1 billion in net cash flow, which included a significant $84.2 billion going towards paying down debt financing activities, also used $84.2 billion in net cash flow, again driven by debt repayments, this time totaling $129.7 billion. At the end of the year, they had $244.1 billion in cash and cash equivalents.
So it seems like they're really focusing on strengthening their balance sheet by paying down a lot of debt.
Absolutely, that's a priority.
Okay, let's wrap up with a quick look at their tax situation for 2024.
For the full year 2024, UBS reported an effective tax rate of 24.6%, however. Without the benefit of certain deferred tax assets, or DTAs, related to the revaluation of assets acquired from Credit Suisse, their tax rate would have been significantly higher at 31.6%.
Okay, so what are DTAs exactly?
So DTAs are basically potential future tax benefits that arise from past losses or deductible expenses.
I see.
Now, the fact that the reported tax rate is higher than their structural rate of 23% is mostly due to operating losses in specific entities linked to those integration expenses, which couldn't be offset by profits elsewhere or lead to the recognition of further deferred tax assets.
So it's a bit of a complex situation, but essentially they benefited from some tax breaks related to the Credit Suisse acquisition.
Yeah, that helped lower their overall tax bill.
All right, so now for the million-dollar question. How does UBS plan to create value for its shareholders?
Right.
This often comes down to things like dividends and share buybacks. So what's the scoop?
So the annual report points shareholders to their investor relations website for the most up-to-date information on their dividend policy. And any share repurchase programs, you can find it all at ubs.com/investors.
Okay, so they're not giving us the specifics here in the report.
Not in these excerpts, no.
But that's where shareholders can go to find all the juicy details.
Exactly the latest figures and announcements.
All right, the report does mention some other things related to their capital structure that are relevant to shareholders. They talk about outstanding additional Tier 1 or AT1 capital instruments with a total principal amount of $6.9 billion as of the end of 2024. And these AT1 instruments can be converted into equity under certain conditions.
Right, so it's a form of hybrid capital.
Okay, and what about employee compensation?
As of December 31st, 2024, UBS said there were no employee options or stock appreciation rights outstanding. Their option-based compensation plans are funded by issuing new shares from their existing conditional capital, of which they had over 12 million shares available at that time.
So that means when employees exercise their options, the company issues new shares which can dilute the ownership of existing shareholders.
Exactly.
Okay, so let's look ahead to 2025. What's the overall economic and market outlook that UBS is painting in this report?
Well, they're expecting continued high economic uncertainty throughout 2025, mostly because of potential changes in U.S. policy and those ongoing geopolitical risks.
So it's a cautious outlook.
Yeah, but their base case scenario is that the global economy will remain fairly resilient, even though they do predict a slight slowdown in GDP growth to around 3%.
Okay, so what about specific regions? What are their forecasts for some key economies?
For the U.S., they're projecting GDP growth of about 2%.
Okay.
But they do warn that potential increases in trade tariffs could hold back growth for China. They expect GDP growth to slow down further to around 4%, mainly because of those ongoing issues in the property market and weaker consumer demand in the Eurozone. They anticipate GDP growth to stabilize at a modest 0.9%, helped by things like falling interest rates and higher levels of household savings.
Right.
And then in their home market of Switzerland, they're forecasting GDP growth of 1.3%, which will benefit from stronger external demand coming from the Eurozone.
So it's a mixed bag globally with some bright spots and some areas of concern.
Yeah, pretty much.
As we wrap up this deep dive into the UBS 2024 annual report, what's your overall assessment of their business as we head into the future?
The key takeaways for me are their clear strategic focus. They're really homing in on sustainable growth in key markets like the Americas and Asia Pacific. They've also made significant progress in managing their costs and reducing the risk from those legacy Credit Suisse assets.
Right.
And while integrating Credit Suisse is still a complex and ongoing process, they seem to be navigating the changing regulatory landscape pretty effectively.
Right.
So despite all the economic uncertainties looming over 2025, UBS seems cautiously optimistic, emphasizing disciplined execution of their strategy and a laser focus on their core strengths.
Well said. Well said. And a huge thank you to you, the listener, for joining us on this deep dive into the UBS 2024 annual report. We've covered a lot of ground today, exploring their different businesses, their financial performance, and their vision of what's next in a world that, remains pretty unpredictable.
Absolutely.
So here's a final thought for you to ponder. Given the enormous scale of this Credit Suisse integration and the ever-changing global economic landscape, what do you see as the biggest opportunities and the most critical risks for UBS as they aim to solidify their position as a leading global financial institution?
It's a question worth thinking about.
It is, and if you want to go even deeper, you can always check out the full annual report on the UBS Investor Relations website.
Lots more detail there.
There is. All right. Thanks again for joining us, and we'll catch you on our next deep dive.
See you then.
Bye.